buyers and owners right now face a dilemma. Technically, the prospect of higher interest rates should take the edge off price rises, and there's evidence of that. But conversely, higher inflation means higher prices, and the prospect that those with debt will have it eroded by that higher inflation. Steph Nash weighs it up.
We're definitely showing that the rate of price growth is slowing.
Record transactions, double-digit price growth. That's in the rear-view mirror. This year, it's all about rising interest rates, signs of higher inflation. Neither good for fueling buyer FOMO.
And I think that's just leading to an overall level of caution. And for vendors, they can't ask these very high prices and achieve them like they were probably 6 or 9 months ago.
Demand for property in our capital cities is apparently moderating. Bidders are seeing less competition. The power relationship between buyers and sellers is starting to change.
So, for the first time in a long time, potential buyers have a lot more choice. And if we look at some of our metrics in terms of demand for properties, it has started to weaken a bit. It's still very strong, but it's not quite as strong as it was at the same time last year in Sydney and Melbourne.
This slowdown that we're recording, it might be a fleeting moment.
Despite buyer demand tapering out, the supply side of the market continues to remain tight.
Overall listings are well and truly down compared to this time last year. We're actually down by about 17%. And so that's not normally a situation whereby you see a major downturn. It's more demand driven at this stage, where there's less buyers in the market perhaps. But at this stage, the sellers are not panicking. They're holding back, if anything.
Inflation, it seems, might be both good and bad for the market. The RBA is tipping underlying inflation to rise 3.25% over the coming year, the highest rate since 2009. While that has some prospective buyers backing off, others see it as an investment opportunity.
If we do see a real breakout in inflation, I think there'll be a rush towards property once again to try and get that hedge in against a higher inflationary environment.
Property is traditionally an inflation hedge because while asset prices and rents rise, inflation erodes the real value of any debt held. There are already signs of this, with the rental market starting to see stronger growth. Yields for investors improve when rents rise.
At this point in time, the rental market, as being well reported in Australia, is very, very tight. And on our numbers, rents at the capital city level jumped by 8% over the past 12 months. And when I look at the last 90 days, rents are accelerating from that point.
If you're an owner, inflation is actually a pretty good thing because you've got your money invested in an asset. So if there is inflationary pressures on the cost to build and so forth, that effectively makes your house worth a little bit more.
So with buyer demand perhaps temporarily cooling off and asset prices naturally rising with inflation, who has the power in the buyer-seller relationship?
We've entered into the new selling season, so that autumn selling season, with a little bit less momentum from the demand side, and still still the right amount of supply. But it's too early to call whether we're sort of back into what we would consider a buyer's market. We're probably more coming back into a balanced market.
I think it's still very much a seller's market at this stage, although it is starting to move more to a bit of an equilibrium. We're still probably a long way from equilibrium, but I expect that throughout this year, we're going to see reduced buyer demand, and supply, at least early this year, is going to be quite strong. So we'll see a move to a more balanced market throughout 2022.
Importantly, regardless of the softness we're starting to see in the market, the long-term view is still very positive.
I've always been consistent in terms of the advice we give around buying property, and that is you've got to have a long-term strategy. You've got to make sure that what you can buy today you can hold comfortably. You've got to make sure you've got good cash flow buffers. You've got to make sure from a repayments point of view that you're thinking about interest rates with a 4 to even a 5 in front of them. It's a pretty good market to be in. Property is a scarce asset, land is scarce, and so over the long term I think you'll do quite well.